And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. It's also Halloween, so have a great time this evening. Be safe with your families. Again, if you live in Houston, weather may be an issue, but kind of enjoy yourself. It'll be a great evening. But it also wraps up the month of October, which means that Election Day is right around the corner, Tuesday. Then on Wednesday, the Federal Reserve meeting, employment data tomorrow. It's going to be busy for the next few days. So the next few days is going to be a lot of stuff going on with the markets. But interesting stuff, though, that's happening. We're going to have some economic data out today in terms of personal income and personal spending. Of course, we saw the GDP report yesterday. That came in at 2.8% growth. A very big chunk of that was defense spending. So again, the question is, can we, what's really driving the economy? We're getting, we have some anomalies in this data that is, won't be sustainable. So we have these kind of intermittent boosts to economic growth. A lot of that yesterday was to defense spending, but underlying that, the consumer is still doing okay. The economic data is fine at this moment. There's not any really big issues in terms of that. The big news last night, of course, was that both Microsoft and Meta came in. Earnings were good. Microsoft's earnings, they beat estimates, they beat revenues. Meta's earnings were good. What got both of those companies were expectations of slower growth in the future. Again, for instance, for Microsoft, their cloud services didn't grow. It only grew at 31%. I mean, just 31% growth, but they were expecting more. And cost concerns for Meta, they're still spending a lot on the metaverse and haven't really turned the corner. $4.4 billion in expenditures there. So again, some concerns there. Both those stocks are going to be down this morning about 3%-ish, give or take. That's going to drag on the S&P this morning. S&P's down about 40 points right now. So just from those two stocks alone, that's going to be a big chunk of the decline. But overall, other earnings are coming in. Okay, I thought an interesting came out, and we'll just kind of talk about Bitcoin for just a quick second. MicroStrategy came out. They missed their earnings revenue. The stock's down a little bit this morning, about 4%. But the market cap for this company is about $42 billion, and they're going to raise $42 billion in debt to buy more Bitcoin. Now, they haven't had sales growth in 5 years. Their sales are absolutely flat in 5 years. So this is strictly a bet on Bitcoin in terms of this. But they're taking on an immense amount of debt in order to buy more Bitcoin. And again, this has got Bitcoin fanatics, going crazy. But, Bitcoin has had a very nice rally here as of late. As we talked about before, this has been pretty much an everything year. Gold's up, Bitcoin's up, stocks are up, everything's doing fine. If it's a risk asset, right? Now, bonds not doing so much this year because they're a safety trade. Who wants bonds when everything else is going up double digits, right? So, you're seeing this kind of this push of everything right now. There's money flows, kind of chasing all assets. But interestingly enough, there's only about 6% of all Bitcoin owners are actually active in Bitcoin. So it's pretty much people sitting on Bitcoin for the most part. But again, that limits the turnover, which increases the available supply to buy or sell is limited. So that drives prices higher. But again, Bitcoin's having a very nice rally right now. And so it'll be interesting to see with MicroStrategy what they can do with, this is, you're betting an entire company and $42 billion in debt on the outcome of Bitcoin. So it's a pretty interesting story. I think this will be one that we look at in a few years and go, that was either a phenomenally genius idea or really terrible, because you're either going to be bankrupt or you're going to be wildly successful, and there's no middle ground. So this is going to be the interesting thing to watch for MicroStrategy. Outside of that, though, again, we've got some more earnings this afternoon. We've got Apple, Amazon coming out after the bell. So again, we'll have a look at those. Now, I like Apple and Amazon today because it's going to tell us a little bit more about the consumer. than it is really about technology or AI. So again, it'll be interesting to see this afternoon just how, have consumer sales, have consumer transactions been as strong as reported. And again, we're going to get the personal income and spending data this morning, and it'll be interesting to compare that to Apple and Amazon's reports tonight to see if those actually compare. Here, but let's talk about what you need to know before the bell this morning. As we get ready to wrap up the month, the S&P just really, and we talked about this the last couple of days, just not doing much here. We have a very narrow compression right now in the price of the market as, really just kind of heading into this election. We kind of talked about, potentially the market de-risking here a bit. And they've been doing it, but just very quietly behind the scenes. There hasn't been a real, aversion to risk heading into the election. But there's also not a lot of bets being made over the last couple of weeks in terms of the election either. Markets have just been very, very flat here and closed down yesterday. Now, the good news is that the market just kind of continues running right along this 20-day moving average, just simply holding that line of support. And every time the market comes down to that level, market finds buyers. Today, though, if the market opens down, we're actually going to take that 20-day moving average out. So again, we could see, if we do close below the 20-day moving average, that does bring the 50-day into range here between Friday and Monday. We'll see if that happens. And again, depends on the outcome of the election as well. Also, the Fed meeting, et cetera. But we're threatening to take out kind of a really crucial level of support today that could lead to a bit more sell-off in the market because of all these algorithms. All the algorithms are kind of watching that 20-day moving average. And so if we take that out today with any type of volume and close below it today, we could see this market move lower. Now, the market could open up this morning or open down this morning and then reverse in the day, end up positive. We've seen that happen before. So we'll see, today, and we'll have this in tomorrow's commentary, but we'll see where the market kind of closes today because that'll kind of give us an indication of what happens next. These very tight compressions of price are going to give us, some idea. And as we talked about previously, we have the sell signal in place. That's why we haven't had any real advance in the market here. Now, and again, as we said before, just because you have a sell signal, it doesn't mean the market sells off. It just means that you're probably not going to go up in price because if you did, then you wouldn't have a sell signal. But again, we've kind of been stuck here for the last couple of weeks heading into the election. That's not surprising. Again, a lot of investors right now just not knowing what to do. As Danny and I were talking about yesterday, there's a lot of investors who go, so I'm not doing anything until after the election. The problem with that is that if we happen to know the result of the election by, say, Wednesday or Thursday, then this market could take off very sharply, depending on the outcome, one way or the other. So we'll see what happens. But again, just the challenge of waiting is going to be playing catch up one way or the other. If the market cracks lower for some reason because of some outcome we don't like, now you're too long equities, you're trying to work yourself out of it. If you're too short equities because you're convinced the outcome is going to lead to a decline in the market and the market rallies 20 or 30%, then that's going to be another issue. But speaking of returns, I thought this was an interesting stat out yesterday. The market has now had the best 12-month, right? So the last year, it's been the strongest 12-month risk-adjusted return for the market since 2018. The only other period in time that has been stronger than that was in 1995 and 1997. So again, 1995, 1997, that rally continued for another couple of years. Then, of course, you had the dot-com crash. 2018, that risk-adjusted return went to a 20% correction by September. So again, you've had a very, very strong return in the markets. And at some point, we're going to give some of this back. Now, that's probably not until next year as we get ready to go into the seasonally strong end of the year. But again, we've had a very strong rate of return that is probably not sustainable as we move into 2025. So just kind of something to keep your watch on. All right, that's what you need to know before the bell this morning. We'll come back. We're going to talk about Paul Tudor Jones and Stanley Druckenmiller. Are they right or are they wrong about their recent thesis on interest rates and bonds? We'll talk about that with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I was just talking about MicroStrategy here a second ago. Michael Lebowitz joining me this morning. Comment in the chat this morning was that MicroStrategy is also a bet on convertible bonds. Yes, that is a bet on convertible bonds with MicroStrategy, and as long as Bitcoin is going up, you're okay. If it doesn't, you're not going to be okay. That's the trick with convertible bonds. It converts into the underlying asset. You don't want to be long that asset if things go the other way. But Mike, that's an interesting point. One of the things that, I'm kind of looking for in the future is that, at some point we will go through a next secular bear market, whatever it is. And however that looks, right? It doesn't necessarily have to be a financial crash. It doesn't have to be a .com crash. It can just be a whole variety of other issues that can create a secular period in the markets where asset prices are under stress, valuations revert, et cetera. But, one of the opportunities that shows up in those types of periods, like in the financial crisis, is convertible bonds that get what they call busted, right? Really become great opportunities. And that'll be something I'm really kind of anxious to look for at some point down the road. But, it is interesting, the way, can you explain just real quick how a convertible bond works and kind of what the advantages to them are?
It's really just a bond with an option to buy the stock. So when the stock gets beaten up, and you're in a financial crisis, the option is worth nothing. So you could basically buy a free option on a stock. Now, MicroStrategy, I wouldn't touch because it's really just a leveraged bet on Bitcoin. But when companies that have real earnings and real revenue, MicroStrategy hasn't had earnings. They've had the same flat revenue growth for 20 years and more or less zero earnings for the last 20 years or so. Their earnings, everything is coming off Bitcoin. So if Bitcoin doesn't perform, the company is done like it should have been done 10 years ago. Just not really, its operating business is not really worthwhile. But but for companies that make money and the stock could go back up again, not that MicroStrategy can't, but the stock can go back up again, you're basically buying pretty close to a free option. And, like you said, Lance, when markets really get beat up, like we saw in 2007, we saw in 2020, the early 2000s, there are great deals in stocks. Stocks go on sale. You get the blue light special in stocks, but there's other instruments, convertibles, closed-end mutual funds, a whole host of instruments that are not well followed, preferred stocks that can trade at really deep discounts for entities that are going concerns. They're not going out of business, or securities that hold assets that are going concerns. So, those are great opportunities to take advantage of, but they don't come around that often.
Yeah, but that also brings up the other side of the coin. Is like right now I was talking about this morning is that, we've got the best 12-month risk-adjusted return for the market over the last year that we've seen since 2018, and before that you have to go all the way back to 1995, 1997. I've got an interesting email from a gentleman just yesterday, actually, or day before yesterday, talking about, well, in his portfolio, he owns a lot of these very high-yielding instruments. A lot of these are tied to preferred stocks, et cetera, that all throw off a decently high yield. So, he's chasing yield in his portfolio. And I'm like, you do realize how much risk you're taking in that portfolio, because the one thing that people kind of don't understand about convertible bonds and about preferred stocks is that if you get into a risk-off period in the markets, those are not risk-free instruments. They can lose a lot of value. 2008 is a good example. We saw a lot of preferred stocks that normally their par value at $25 trading at $7, $8 a share during the financial crisis. They were good companies underneath it, but you lost 50% of your money, by owning the preferreds during that financial crisis. So the important thing to understand is that all these instruments, and particularly instruments with high yields or instruments like convertible bonds that are basically an option on the stock, there's a tremendous amount of downside risk. They are not a risk-free investment.
Right, and liquidity in those type of events is very interesting. So what we saw in 2008 was that the most liquid assets were being sold, and that's because the least liquid assets, there was no market. The market was closed. So you had these preferreds for names like Goldman Sachs, Morgan Stanley trading at, between $5 and $10 that are worth 25. Fed, even if you think they're going bankrupt, the Fed's not going to let that happen. But you couldn't sell it. The market was essentially closed. This was going on in subprime as well. So people had to sell gold. They had to sell, Microsoft, Apple. They had to sell the most liquid things because they had to raise money because so many investors are leveraged. And that's an important fact, because that's very much what's going on today too, is that leverage can kill, because the only way to reduce leverage is to also, you have to sell the assets that the leverage support. And a lot of times that can be 5 to 10 times of the amount of debt. So for every dollar of debt, you may have to sell $5 or $10 worth of some asset, and that asset better be liquid.
Right, exactly. Well, and that's I wrote this article recently about the guy in Canada that lost $418 million betting on Tesla. Right. And to your point about leverage kills, he was heavily margined, and the problem with that is that when your asset price declines and you're on margin, you have to sell assets in order to meet your margin call. But the problem with that is that now your marginal, the amount you have to margin has gone down, which requires more margin calls to meet that margin, which reduces your assets more, which reduces your margin line, which triggers more margin calls. And and that's why he went bankrupt so fast, so quickly. That $418 million just literally evaporated with the decline in Tesla, because he was just getting one margin call after another, and he could never get enough breathing room to allow the stock to heal up. It just kept going down, kept going down, kept going down, and it just kept triggering more and more margin calls. And that's the problem with margin. It's like gasoline. As long as the markets are going up, I can store gasoline in my garage. It's not a smart thing to do, but you can do it as long as it's not near, a flammable source. But as long as the container's in a safe place, as long as it's sealed up, it's fine. And that's the same thing with margin. As long as prices are going up, it's inert. It's fine, right? Leverage works fantastic on the way up. The problem is you throw a match in a gas can, you got problems. And same thing with margin. It works fine on the way up. Investors get lured into using that leverage. On the way down, it becomes very explosive very quickly.
And here's another point. We don't use margin in our clients' accounts, and many of you may not use margin. But if a lot of other investors are using margin, they get caught into that trap and they have to forcibly sell. So just because we're not using margin doesn't mean we don't have to be aware of it.
Right.
And because it can bring down prices with it. So, just because you're not using it doesn't mean it's not a risk to you.
That's right. Just real quick, when we come back from the break, we'll talk about your article on that you put out yesterday on Stanley Druckenmiller and Paul Tudor Jones. But just any takeaways last night from Microsoft or Meta that kind of shocked you or anything?
No, again, I think the markets are seeking perfection, and it's just really hard to get perfection. NVIDIA seems to be the only company that can consistently do that, where they beat on sales, they beat on earnings, and then they even make their wild forecast even wilder. But
that will end at some point.
Of course it will.
Yeah.
Of course it will. And AMD, look, that was down, 10% yesterday. That's NVIDIA's biggest competitor. So maybe there's some risk in the air for NVIDIA's earnings, which come out later next month.
But AMD is a great example of that, right? They doubled their revenue over the last quarter. They doubled their sales over the last quarter. They're killing it in terms of that. The market was just disappointed that they didn't raise their guidance to some astronomical level. They kept their guidance where it was. Right. Wall Street was disappointed. It's like, oh wait, you mean you're not going to tell us you're going to triple revenue next quarter, right? Right. And that's the problem, is that Wall Street is getting very optimistic on all this. But when it comes back to AI, Microsoft and Meta is a good example. They are not tapping the brakes on their spending on AI, and that's one of the primary beneficiaries for NVIDIA, to NVIDIA, right, is their spending, because they spend so much money buying GPUs and chips and everything else for AI. They're not cutting their spending, but it's just that Wall Street has now got to realign expectations with a bit of reality.
Right.
Even when you're growing stuff at 30%, which is pretty incredible, right?
It is, but if you're priced for 30% growth, you better keep that up, or the market's going to be disappointed, right? Everything has a price associated with a growth rate.
Yeah, that's right.
But I think guidance is equally, if not more important for some of these companies than their earnings and revenue. So, just because you think that the company met or exceeded on earnings and revenue, pay close attention to the earnings call afterwards to see what their guidance is and how it changes.
When we come back from the break, we're going to go through a few charts. Mike wrote an article yesterday, and I've got one coming out next Friday. We've gotten so many emails about recent comments from Paul Tudor Jones, Stanley Druckenmiller, Ray Dalio, talking about interest rates, debts, bonds, etc. So Mike did an article on this yesterday. It's on the website now. We'll go through those charts when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife and I are in a huge fight. She says I absolutely don't love her anymore. And I said, honey, that's not true. I just said you can't put the Christmas tree up yet. It's not Halloween.
Does she want one tree or both of them up now?
She wants them both up. We compromised with Thanksgiving stuff on the table and Halloween stuff in the living room.
The Real Investment Show podcast. Same show
Yeah, I'm surprised she's not wearing her Christmas sweaters yet.
at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So if you go to our website, realinvestmentadvice.com, you will find a lot of information there. Mike and I write religiously on a regular basis, and basically that is our research. So when we're talking about things here on the show, as an example, these aren't things that we're just kind of making up as we go. This is stuff that we've done fairly exhaustive research on, have run the analysis, built the charts, built the graphs, written articles about it, so you have it as well. And I've told you before, if you're listening to the show, you're only getting a very small dose of the information that we make available to you in terms of managing your own portfolio. And this is why you should go to realinvestmentadvice.com, go to the Insights tab. There's our daily market commentary, our blogs that we post 3 times a week, our newsletter that comes out every weekend, all the videos, all the podcasts. It's all there for you. But if you're only listening to the show and watch the YouTube channel, hey, we appreciate you. Hit that like button for us. We appreciate that. But you're only getting a very small dose. And we only have so much time here in the morning to really dig into a topic. So these articles are much more in-depth discussions with all the relevant charts and graphs and data to support the conclusions of our thoughts. And then we apply that. That's our research that we apply to our portfolio management and why we have convictions in some ways or the other. Right now, Mike and I both disagree. I wrote an article recently. If you go to the website, realinvestmentadvice.com, type in Grant, you will see an article we wrote about James Grant and his theory about interest rates and bonds and why he's probably wrong. then, of course, over the last couple of weeks, Mike and I have both been inundated with emails from people saying, "Have you seen this video, this interview with Paul Tudor Jones and with Stanley Druckenmiller?" Yes, trust us, we see all of it. Mike and I, this is all Mike and I do all day long is look at both sides of arguments and do our research. So Mike has written an article today, or yesterday. It's on the website now, talking specifically about Paul Tudor Jones and Stanley Druckenmiller, their views on interest rates and debt. And, the question is are they right? They could be right. There's always the possibility they could be right and we can be wrong. We never say we're absolutely 100% going to be right. But what we do is look at the data and try to draw some conclusions from the overall data. So having that premise set up, Mike, We'll kind of go through some of the charts here that you've done. So kind of start at the top of your article so that I can kind of I'm gonna display your charts for you. So kind of start at the top of the article and we'll kind of go through the charts as we go.
Yeah, we'll work our way down, and it's kind of divided into two broad sections. One is inflation and one is deficits. And in the article, I try to tackle some of the stuff that Paul Tudor Jones and Stanley Druckenmiller have said. And if you don't know them, they're the Michael Jordans of the investment world. They've made a fortune. They're very well known. They have a high success rate. So writing an article going against some of what they've been saying is not easy. You're playing Michael Jordan. It's hard to win that game. But we've seen a lot of these bond bearish narratives, and it's worth going through them and putting them into context so that you can better appreciate whether bonds are a buy here or whether you should join them and short bonds because yields are going to go higher. But there's a couple important caveats when you're talking about people like Paul Tudor Jones and Stanley Druckenmiller. A lot of times they're just putting on short-term trades. So they may have been short for a month, for 2 weeks. They also like to what's called talk their books. In other words, like let's just say Lance had hundreds of millions of people following him. Well, the best strategy we could do then would be to buy a stock. We buy IBM today. About a week from now, Lance starts writing up IBM. And then every morning he's talking about IBM. What a great buy. It's going to double. It's going to triple. And you know what? People follow. And it's a great strategy. And then at some point, Lance would sell off into that and take advantage of the higher prices. So we don't know what their aim is, whether it's to make a few quick bucks in a few weeks, or whether they're really making long-term bets that yields are going up to 6, 7, 8%. And we also, have to consider their political views. We know, I don't know much about Stanley Druckenmiller's views, but I know Paul Tudor Jones is supporting Harris and he's anti-Trump. So when some of his comments are just Trump's going to run up the deficit. So are some of these things that he's saying politically biased as well? So that's kind of a caveat. And just to keep that in mind when you hear anyone on CNBC, a lot of times they're talking their book. They're trying to get investors to follow along and make them more profits. So when we kind of start talking about is another round of inflation likely, a lot of people harken back to a few years ago. And that one's pretty easy to debunk. Look, at that time, it was a huge amount of fiscal stimulus in America and around the world going to a lot of people and companies that couldn't spend the money at first. Then at the same time, you have a broken economy. People didn't want to spend money. You couldn't spend money in some instances, and supply lines were breaking. And look, at its core, inflation is supply and demand. So what happened? Eventually, demand skyrocketed because people, first of all, unemployment spiked, but it came right back down. So everyone had their jobs. They hadn't spent money in a while. They were saving money. And then the government dropped money on everyone. So there's a huge amount of money looking to spend. And at the same time, the supply lines were just crushed. So there was no supply of goods. And you have your classic supply demand driven inflation. And it's taken, 3, 4, 5, what's it been, 4 or 5 years to finally erase a lot of that as savings are now below where they were before the pandemic. The money has been spent. A lot of the fiscal stimulus is largely out of the system. And the supply side of the equation is virtually completely normalized. And behaviors played a big role into that as well. So the second argument, and I've written plenty about this, we've talked about it, is that a repeat of the 70s is going to happen. It's a completely different environment. And if you go look, I wrote 4 articles on a topic. It's worth just going back and checking them out because it goes into a lot of mistakes that were made by the Fed, by the government. Their misunderstanding of the relationship between employment and prices, their fear of the 1930s, of depression, of things like price wage spirals, of the oil embargo, which was an external force that there was not as much control over. So some of the other arguments are that the government spending is going to boost inflation, deficits. The problem with that argument is that there's a thing called the negative multiplier. And what the negative multiplier really says is that when the government spends, and assuming the government isn't spending productively, in the 1930s, there was some productive spending. They built like the dams, the Hoover Dam, a whole lot of projects that actually were productive. Almost all the spending today is unproductive. So what happens? They spend the money, it ripples through the economy, you get some nice economic growth out of that. But then the money has to be spent, and that detracts from earnings growth. Plus that money wasn't spent on something more productive in the private sector or by the government. So you get a negative multiplier. So the government will spend $5 trillion, boost the economy by $6 trillion, but then over time it detracts $7 or $8 trillion from economic growth. And that's the problem right now, is that you had the boost that caused some inflation, but now we've just increased our economic headwind even harder than it was before the pandemic. Some people say that we're going to import inflation. My question is, from who? No one else has inflation. Japan has had 0% or negative deflation for a long time. They're finally getting an uptick in inflation, but they're talking about extremely low rates of inflation. China, who we import a ton of goods from, it has a deflation problem. Their inflation is close to 0. And then you look at the Eurozone and UK, big trade partners, their inflation is falling a little bit quicker than ours. And we actually ran, we chart our inflation versus the Euro, UK, and China, and you can see they're very well correlated. And China, if anything, is pulling everyone else down. But then we created a multiple regression formula based on those. And the R squared, which basically tells you how good that relationship is extremely high. I believe it was 0.86. But more importantly, what it tells us is that those 3 countries' inflation is a very good barometer for U.S. inflation. And if anything, U.S. inflation should be a little bit lower than it is. So, those are some of the kind of the core inflation arguments that are being thrown around. The big one that we hear constantly that does have some political ramifications are deficits. And there's a lot to unpack with deficits. And maybe that's something that we tackle after the break.
Yep, I was just going to say this. That's kind of a good stopping point. But yeah, we'll come back and I want to pick up with the debt to GDP. That is, of course, the big kind of talking point going in this election, is that, both candidates are going to spend all this money. They're going to create all these deficits. The debt to GDP is going to be crazy, and we're going to go broke, right? And this is really the essence of Paul Tudor Jones' argument, is that the U.S. economy is going broke, which it can't do. And we'll talk about what's actually going on with this when we come back from the break in terms of debt to GDP and deficits, etc. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. We're just going through a lot of the discussion about debts and deficits, and there's a lot of people saying things for a whole variety of reasons, whether they're talking their own book or whatever it is. We're just kind of going through the charts and the graphs that, kind of talk to these specific points. And I see a lot of the comments in chat too, is like, oh, this is going to be like the 70s. And no, we don't have the economy that we had in the 70s. In the 70s, we were 80% manufacturing, 20% services. Today, it's inverted. We have 20% manufacturing, 80% services, which is deflationary, not inflationary. We had an oil embargo that led to a massive oil spike in prices that led to inflation. As soon as that was resolved, inflation collapsed. So, yes, you can have exogenous events like we saw in 2021, 2022, where you have a big spike in inflation because you shut down the economy and gave people money to spend. Supply-demand imbalances create inflation. That's over with. So now we're going to return to some level of normalcy that will equate back to global inflation. It'll equate back to, inflation, interest rates, wage growth, which just yesterday we had the ADP employment report, very strong employment report, but wages declined. And the rate of wage growth continues to decline, which is direct feeds into inflation. If you have less money to spend, then inflation is going to go down. That's a supply-demand function. So that's why we're going through this. And look, and again, I want to be really clear. The reason that Mike and I do this work and write these articles is that we have an opinion, but we do this work. And if this work comes out and says our opinion's wrong, we'll say, hey, you know what? The data doesn't support our opinion. We'll change our opinion and we'll change our positioning in our portfolios. That's our job, right? So if something changes and all of a sudden we start having rising inflation and there's an underlying cause to that is a sustainable cause for rising inflation, i.e. we shut down the economy again and start fueling people with checks, we'll close out our bond positions and go buy stocks, right? Because that's what'll win. So that's why we do this work. We're not doing this work just to debate people. That's not why we do it. We're doing this to confirm whether or not our theses are correct. And if the data doesn't support it, we'll change our thesis. And this goes to one of the recent comments, Mike, that has been running around. A lot of people, especially in the media, Lots of commentary, from the political aisles, et cetera, about the debts and the deficits. And we have the surging deficit with all the surging spending, the debt to GDP ratios. We're going bankrupt as a country. But again, that doesn't really seem to hold up with the data, which is why we keep coming back to the data.
Right. And this is the don't shoot the messenger part of the part of what we're going to talk about, because I'm going to put some context to the deficits. And look, Lance and I both believe that these deficits that are continually growing are a big problem.
Yeah, they're not
Not good. But why are they not good? Because they're slowing down growth. They're slowing down our prosperity. But they're also deflationary. So let's talk about deficits. Deficit on its own, whether it's 1 trillion or 4 trillion or 8 trillion, is a meaningless number. If a Martian landed on Earth and said, hey, we only run a $1 trillion deficit, what does that mean? What's their GDP? How big is the economy on Mars? And we don't know that. So I hear everyone talking about the deficit, but no one talking about the fact that the economy is about 33% bigger than it was before the pandemic. So most economists like to look at debt to GDP, and our debt to GDP trend in this country is awful. You can see it's been rising for the last 45 years. And the graph shows a trend line, and you can see in 2020, 21, we spiked well above that trend line, clearly unsustainable. But what's happened for the last 3 years is that we've pretty much flatlined or slightly even declined. So even with that extra $5.5 to $6 trillion of spending above and beyond what the government typically spends, our debt to GDP ratio is about in line with the trend growth. Again, we don't want to see that number, the ratio rising, but if you look at that graph, is it that far out of whack? And then, you can get a little creative with how you look at that. What if, because again, we're trying to see if this time is different than it was prior to the pandemic. We know that there was a huge anomaly in all kinds of economic financial data in 2021. But is today different? Is 2024, what we're looking at for 2025, different than it was prior to the pandemic? So if you take the debt and you strip out the $5.5 trillion of fiscal spending devoted towards the pandemic, and you assume that interest rates would have stayed on their government's interest expense would have stayed on trend, and then you recalculate the debt to GDP as we're showing you, you'll see that the debt to GDP ratio is actually lower than it was before the pandemic. And it's been basically flatlining for the last 10, 15 years. So be careful not to, first of all, assume that just because that deficit number is so large that it's that much different than it was before, because the economy is much bigger as well. And again, this just puts everything in context. We're not condoning, we're not saying this is great, but we are saying is it's not really that different than where we were before the pandemic, when growth was anemic and the Fed was fighting to get inflation up.
Yeah.
We also hear about the money supply. The money supply is going through the roof. That's not really the case. The money supply popped significantly during the pandemic. And since it has come back down, it was actually shrinking for a while. It's slightly growing now. But again, if you look at the money supply as a function, as a ratio of GDP, you'll see that it's decently below its trend. So the more GDP, the bigger the economy, the more money you need, the higher the money supply should be. So in fact, if you're looking at just the money supply, you'll see that it's actually below trend. Paul Tudor Jones has mentioned that we're on Japan's path. We're going to have debt to GDP ratios of, I think they're 260%, which is double ours. Let's look at Japan. What do they have? They have an economy that hasn't grown in 15 years. They have an inflation rate that has flirted with deflation on and off for the last 20 years. That's awful. That's not the road we want to be on. But if you're a bondholder, that's the road to significant profits. Zero inflation and zero economic growth turns into zero yields, which is what Japan has had for a long time. And they're finally raising rates now, and they're at 1% for a 10-year bond. That's with a significant rise in yields. So if he's threatening that we're on Japan's road, from a fiscal perspective, that's awful because it means no growth. The economy is going to stagnate. But from a bondholder's point of view, you couldn't ask for much more. And let me just leave it with, Paul Tudor Jones, too, has been kind of talking about Trump and how he's going to run massive deficits and it's just going to create all kinds of problems. Well, let's just assume that Trump wins and the Republicans sweep Congress and Trump can do whatever he wants. There's a few problems with that. The Democrats are still going to have close to 50% of the House and Senate. So the Republicans need just about every single vote they can get to enact whatever it is that Trump would want. And then you have a little thing called the Freedom Caucus. And that's the far right side of the Republican Party who want balanced budgets, who don't want government spending. So if the Freedom Caucus can just get, 4 or 5 votes, 6, 7 votes in the House, a couple votes in the Senate, and get the Democrats to go along with them to stop Donald Trump's going to have a tough time doing this massive deficit spending. And then second, you just don't know what he's going to do or what Kamala Harris is going to do. It's there's a lot of rhetoric that goes into these campaigns. What they actually do is often very different from what they say they're going to do. So you just take everything with a grain of salt, put context to everything, and ask yourself one important question. Is today, not 2020, 2021, is today very different from 2018, 2019, 2017, 2016? Are those trends that were existing then no longer relevant? And if the answer is that we're on a new trajectory, everything has changed, well, then rethink your bond strategy.
Yep.
But if you think that we're back on the path of where we were before the pandemic, and the pandemic was an anomaly, then bonds at 4.5% yields are an incredible buy.
Yeah, let me just conclude this with Lacey Hunt, who just wrote his third quarter piece on his research. The headline and core inflation rates will continue to recede in an environment of more excess capacity combined with the monetary restraint of the past 2 years, which is still working its way through its economic conditions. Accordingly, the Federal Reserve will have the latitude to lower policy rate further. Moreover, additional cuts will be needed to reverse the multi-year decline in real detrended monetary supply growth. At the same time, long-term U.S. Treasury bond yields will follow the downward path in inflation. This pattern has been extensively researched and well documented. The current evidence of slow growth of real money supply globally and its impact on the world economy suggests the pressure for long-term Treasury yields to fall is increasing. So if you don't believe us, listen to Lacey Hunt. He runs a $3 billion Treasury fund for a reason. So, Mike, thank you so much. Get by the website, of course, as always. That's where you'll find all of our latest research. Again, if you're just listening to the show here, you're missing so much of the data that we put out for you to help you manage your money better. RealInvestmentAdvice.com. You can also follow us on Substack, Twitter, you name it. We're just about everywhere to make your life easy. But the data's there for you. So have a great weekend. Have a happy Halloween. Be safe. And we'll see you back here tomorrow for Financial Fitness Friday. Hit that like button.